I think, to be honest, in the morning it was quite a shock when I read the news, and then also markets reacted that way. But as you mentioned, we see a bit of a de-escalation. No one really apparently wants a war, and we assume also in our base case scenario that we don't see a full-fledged escalation and a war on that, but rather de-escalation. It might weigh on markets and loom over markets over the next couple of days. But in the base case, we don't expect long-lasting impacts on the economy or financial markets.
Okay, because the threat has been there for some time. So why do you think the reaction was so swift and so sizable as well? We were looking at the Japanese market down by about 2%, US futures down significantly. We did see oil bounce by about 4.5%, gold above $1,600 an ounce. Very quickly, though, moving back to, I guess, more normal trading ranges.
Yeah, well, I think in the beginning there was a bit of a big risk scenario here that this might escalate quite dramatically, and then Iran has quite an impact actually on oil supply, and so for the global economy there is a potential really negative risk scenario of a negative oil price shock. Supply shock for the global economy. And so I think this explains to some extent that markets were a bit shocked in the morning. But as now both sides basically indicated no one really wants a war, I think markets calm down a bit.
I was chatting to one of our guests a little bit earlier on about how much higher the oil price has to go before it constrains the global economy, crimps consumer demand, adds to significantly to inflation. He was telling me that we'd need to see oil prices essentially double from where they are right now over a short period of time. Would you agree with that kind of assessment?
Yeah, that sounds reasonable. According to our estimations, I think an increase of 10% has not really a big impact. It is a sizable impact, but not too negatively on various countries. For instance, for the Eurozone, we expect just a negative impact on growth of around 0.1 percentage points on GDP, or a 0.2 percentage point increase on inflation. And as we know, inflation is anyway running quite low. So in the short term, at least, there's no big risk stemming from that.
What's your outlook then for the global economy and for global equities over the course of 2020? It's been an interesting start to 2020 so far with what we've seen in the Middle East, but we're coming off a stellar 2019 for markets right around the world, whether or not it's here in Asia, in Europe, and of course the United States really leading global equities higher.
Yeah, I mean, if we look at the economy, I think we expect that the global slowdown that we've witnessed last year is bottoming out early this year. We have strong indications for that. If we look, for instance, at leading indicators, economic sentiment in various regions improved recently. So this is actually good news for both the economy and financial markets. Add to that the big central banks, especially the Fed, but also the ECB, acted quite swiftly last year. So this is adding additional support. And we have some positive outlook actually on the trade war between China and the US. So all in all, we think in our baseline scenario, the economy is kind of bottoming out and then gaining traction later this year.
Which region is going to lead that turnaround, and how do you take advantage of that as an investor?
We expected a bit more stemming from Europe and emerging markets. The US is actually doing still quite okay. We have seen also a slowdown there last year, but not as severe as in other regions. And we would expect that the rebound is stronger in other regions, for instance, in Europe.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.